In this video, I'll share with you the current state of the market for multifamily real estate investing, otherwise known as apartment investing, what I'm currently seeing and what I believe is going to happen over the next 6 to 12 months. Now, it's important for you to know this video was made in August of 2023 and the environment is going to change. So if you're watching this way in the future, just know that things may be different by the time you watch this. Now, it's no secret that real estate has been in the news and some real estate sectors have had some issues. With all the changes in the economy, real estate, such as apartments, has been impacted. But what is truly happening and what's the best way to respond? I'm Dan, an active real estate investor with hundreds of apartments, and I'm on a mission to help immigrant professionals grow their wealth passively through real estate. If you want a copy of my passive real estate investing guide, just click down below in the description. Now let me first talk about what's happened in the market and how we got here. The biggest factor that's affected apartments is the rise in interest rates. The Federal Reserve, chaired by Jerome Powell, sets what's called the federal funds rate. This rate impacts all loans made on housing. And this is for any kind of loan, not just housing, also auto loans, small business loans, you name it. The reason the Federal Reserve has been increasing interest rates so rapidly is to slow down the increase of inflation. And that's been in the news quite a bit. High inflation is not good for anyone, especially individuals and families on fixed incomes. So it's the Federal Reserve's top priority to lower inflation. And the way they do that is primarily through increasing interest rates. It essentially makes borrowing money more expensive, which decreases demand and ultimately lowers inflation as well. So here you can see the rate of inflation over the last 20 years, and it's bounced around between around 6% all the way down to 0. But over the last few years, it's been a huge increase in inflation. So let's zoom into these last 5 years to see what happened. So you can see that 2018-19, inflation was right around 2%. And then in the beginning of the pandemic, which was March of 2020, it temporarily dropped to close to 0, but then it skyrocketed over the next 2 years to a high of over 9%. Now this is substantially higher than the 2% goal that Jerome Powell keeps stating and the Fed keeps stating. So how did the Fed respond? So if we superimpose the federal funds rate on top of the rate of inflation, you'll see that towards the beginning of 2022, the federal funds rate increased from close to 0 to over 5%, marking one of the fastest increases ever made in such a short amount of time. Now, banks set their interest rates based on this federal funds rate. So loans for apartments and housings increased by 5% or more in that same period, which is huge. This means that the potential mortgage payment for an apartment complex, which is by far the biggest expense, increased substantially. This rapid and unexpected rise in interest rates is what caught everyone off guard, and it's the source of a lot of the issues we're seeing today. And these issues can be summarized with 2 observations. The first is that many multifamily properties were purchased when rates were super low. Let's hop back to that graph I showed you a minute ago. You'll see there was a period between early 2020 and early 2022 where interest rates were close to 0. And this is a period where there was really a lot of acquisitions of multifamily properties during that time. Because it was cheap to borrow money, sales of apartments accelerated rapidly and were sometimes purchased at inflated prices. Rents during this time were increased substantially due to inflation, the lack of supply, and the period saw many new apartment investors get into the game without a lot of experience and sometimes just paying too much money. I myself started investing in apartments during that time as well, but I partnered with an experienced real estate investor to avoid getting my investors and myself into hot water. And it was the right move. I still remember making offers on apartments during that time that we thought were at prices that were very reasonable and got outbid by a lot. And once I heard how much the complex sold for, I wondered how in the world did they make that work? The second point is that many of the loans that were used to purchase those properties during that time were temporary variable rate loans that did not have rate caps. Let me explain. A vast majority of those apartments during 2020 and 2021 were purchased with something called a bridge loan. It's called a bridge loan because it's meant to be temporary. less than, let's say, 3 years. And it takes you from your acquisition date all the way to a period where you can put long-term fixed rate financing on that property. Now, bridge loans have a lot of advantages. They're great because you can close quicker. You don't usually have prepayment penalties, which is a big issue. They can often include the cost of renovations, which is a great thing because that's often a very big expense. But these types of loans are usually variable rate loans, which means that their interest rate increases or decreases based on the federal funds rate that we just talked about. This means that as the interest rate increases, so does the interest rate of your mortgage, and so does your payment. And if your revenue and other expenses are flat, that spells trouble. Now, some smart investors in that same period purchase what's called a rate cap, which is essentially an insurance policy that caps the rate at a certain point. If the interest rate ends up going above that point, then the investor gets compensated to make up for that overage. This was smart to do, but not every investor did it. So why? Well, there was little reason to think that interest rates would increase. And even if they would have increased, they would increase at a more gradual process like it's happened before. Well, that's not how it turned out. Now there are a number of properties that are in financial distress. Note that I said financial distress because the property itself could be a great property being run very well, but it's the type of financing that was placed on it that caused the issues. Even Blackstone, the world's largest alternative asset manager, has had issues recently with some of their multifamily investments. So it's not just the small players that did this, it's even the biggest ones. So what do the next 6 months look like? My belief is that there's going to be a large number of properties coming up for sale because they're under financial distress. This will mean that we're going to see some incredible deals come our way. Did you ever think, boy, I wish I would have bought a home back right after the 2008 recession? Wow, what a buying opportunity that would have been. Well, I think we're entering into another period like that when it comes to apartment investing. And I'm not the only one that thinks this. Brookfield Asset Management, who owns more than $850 billion in assets, believes this too. Just 1 week ago, CEO Bruce Flatt said this: "We're in an environment with higher interest rates, higher inflation, and tightening lender requirements, all of which create uncertainty and pockets of stress in real estate markets. The current market will lead to the best environment we've seen since 2009 to execute on our long-standing investment strategy for real estate." You see, the current pain we're seeing right now with interest rates is a variable that we know now, so we can account for it in all of our analysis. If a deal cash flows, which means it's profitable, it's making money at the current interest rates and at a very low price, then it's probably worth pursuing. And it may end up being a once-in-a-decade opportunity. But again, only if the deal makes sense using sound analysis principles. What happens to interest rates in the future is anyone's guess, but many experts right now are thinking that we're probably close to the end of the increases, given that inflation has decreased substantially, though it's not yet at the 2% goal that the Fed has stated. How fast they'll end up decreasing over time is anyone's guess, but my sense that it's probably going to be gradual. This means that the difficulty for some apartment investors is going to continue, and if this is the case, we will see many more properties come for sale at bargain basement prices. So just to reiterate, apartments are a sound and solid asset class. Housing is something we're always going to need, and it can't be impacted by artificial intelligence or whatever new technology comes out because it's needed. We need housing. And many people have done well with steady and consistent investment in apartments. So what do you think? What's your take? Let me know in the comments below.